Hey guys, it's Dan here. In this week's episode, let's talk about Eurobonds. So in this video, you will learn two things. First of all, of course, what is a bond and what is a Eurobond? What makes it so special? And second of all, is it worth investing in such a Eurobond, and who should invest inside, who should not invest inside? Well, let's talk about all these things. All that being said, ladies and gentlemen, let's roll. Okay, so as always in my videos, let's start with the basics. Today, as we are talking about Eurobonds, let's recap what a bond is, because maybe that's not clear to anybody. So a bond, there are two ways to looking at a bond. Either you are buying a bond, and that means you are lending money to somebody, or you are the issuer of the bond, so you are issuing a bond, and in this case, you are asking for a loan, basically. So this sounds pretty complicated, but let's look at an example and you will see it's always a three-step process and it's not that complicated actually. On one hand side, you have a company or a country, and on the other side you have some kind of investors. So now let's take the example of a company first. Imagine your name is the car company Ford, for example, and you want to electrify all your cars, such as your pickup trucks. To do so, to electrify all your cars, of course you need a lot of money in advance. So what you could do, and usually people like to do it in Europe, big companies, they could go to banks and they are asking for financing, but especially bigger companies such as Ford, especially in the US, will try to tap the bond market, which means they will ask bond investors to lend the money because they can ask for more, and it's just a deeper market. So if you need a lot of money, let's say to electrify a car, for example, which costs billions of dollars, of course you can ask the bond market and the future investors if they want to lend you money. Another example, so this was the company example, another group of people who could issue a bond is a country, for example. Let's imagine the United States, for example, right now or last year, they needed a lot of money for COVID and everything which was around COVID, for example, or to build new roads or something like that. For this, again, you need a lot of money, so you can tap the bond market, you can issue some bonds as the United States, for example, and ask investors and if they want to lend you money for the long term, for example. Okay? So now that we have understood this side, let's try to understand the investor side. So as I just mentioned, let's say Ford or the United States, they will issue a bond. So they will basically ask investors, do you want to lend us money and we pay you back with interest? And here the investors will maybe be interested in lending money, of course, in exchange for interests. So investors, a bond investor is basically kind of a bank who lends money in exchange of interest rates, of course. They're not doing it for free. So what happens is once the bond is issued and the investors have agreed, yes, we want to lend you money, they will lend money. Imagine here my company or my country needs $1,000. They will issue a bond for $1,000. The investor will say, yeah, sure, we can lend you the $1,000, and at the end of the process, the company or the country, let's say after 10 years or whatever the details are, will pay back the $1,000 with interests of, let's say, 2 or 3 or whatever percent. Of course, there are specific markets for that, and everything is set up in advance, so you know all these kind of things. So this was the basics about the bonds. Now let's look at why are Eurobonds so special actually. Okay, now that we know exactly what bonds are, let's look at the topic of today, which is Eurobonds. What exactly are Eurobonds and what has changed, especially in 2020? So to understand Eurobonds, you have to understand what was actually before 2020, because there was a big change in mentalities, especially in Europe, before 2020 and since 2020. Let me explain. Before 2020, what you have to understand is that the euro, the currency euro, started in the European Union in about 2002, so about 20 years ago. So a lot of things economically happened all together, where the euro was managing it, or the European Union was managing it, but fiscal policies in each country and the way countries were asking for debt or creating debt was individual. So Italy was creating its own debt, Germany was creating its own debt, and so on and so on. This gonna continue, but in a different way actually. So this is where it gets interesting, because before COVID there were already discussions about euro bonds, but especially the Germans always said no, we are not interested because we have a strong country and we want to do it ourselves at a cheaper cost. So that was the idea. But since COVID hit, it hit the European Union very hard, and this is where the shift in mentality came into place, and shifted also to this kind of old idea of Eurobonds, but now it is actually happening. So what is happening here? Before 2020, as I just mentioned, each European Union country, so the 27 minus England is 27, was issuing their own bonds, meaning they were in charge of their own debt. And this led to pretty significant differences, especially when we're talking about bonds, because the German 10-year bond, so when Germany was asking investors to lend them money for 10 years, well, the 10-year bond, German one, was yielding, so was giving investors minus 0.3%. That means, so negative interest rate, so if you were lending money to Germany, you were losing money, minus 0.3%. Because it's a super safe country and there is no risk of default, so you're basically lending to Germany, who has basically who has the best rating, and therefore absolutely no risk lending them. That's why the Germany has the lowest yield or interest rate giving back to investors, because it's such a safe country. On the other side, you had Italy, for example, which was plagued with a lot of problems, especially during the Euro crisis, and that's why you can see that the yield, or the interest rates Italy was paying for a bond for 10 years to the investors was plus 0.7%. So if you were investing into Italy's debt, you were making 0.7% for 10 years. So that doesn't sound like a big difference, but as you can see here, the gap is about 1 percent point, and that's a huge gap in yields, especially because, I mean, both countries are neighbors, but of course in very different financial situations. So now came 2020 with the corona, which hit the kind of the worst performers before, even harder. When you look at Spain and Italy, they were already struggling, and with the COVID situation, COVID was worse in Italy and in Spain, and it was also worse for the economy because they really rely on tourism, for example. So then came the idea, okay, let's do some Eurobonds, because this COVID epidemic is such unfair for Italy and Spain that we have to issue debt together, because it's gonna help us recover faster as a country, or as a continent, basically. So this is what happened actually since 2020. Now there is one issuer for all European Union countries, and as you can imagine, now it's the European Union. Kind of logic, but it took a lot of time and a lot of efforts and legal stuff to get it done. So now the European Union is in charge of the debt of all the 27 countries. So when they are issuing debt to investors, you can buy debt for the entire 27 countries at the same time. So why is it such a big deal? Well, first of all, the amount, 800 billion euros, that makes the European Union one of the biggest lenders on the bond market, so that's absolutely huge, until 2026, because they are saying it takes like 5 years to, well, 5 years of debt issuance to get where we wanna go, money-wise. And to give you an example and to see the difference, now the 10-year Eurobond, and I'm simplifying a little bit and I'm rounding, gives you about 0.1% interest. To compare, as you can see, it's much better than Germany, because here you got negative interest rates, here it's slightly positive, but also, of course, it's a worse interest rate than Italy alone, because, of course, the European Union itself is much more solid and strong economically than Italy, so the risk of default, not paying you back as an investor, is much lower. So now, is it worth investing in Eurobonds? The big question. Well, I would phrase it like this. If you were already into bonds, and let's say if you are buying German bonds or Italian bonds or whatever, then it's probably a good idea to do so. Why? Because the German 10-year bond gives you a negative interest rate, which is always bad, of course. You are paying for safety. Germany will never default, but you get a negative interest rate for 10 years. So basically you are losing money when you are lending. Then on the other side you have Italy, which gives you 0.7% of interest rate about 10 year. But of course it's a much more risky country due to all the things I've mentioned before. So now the big question, if you're already investing in one of these, then the new 10-year Eurobond makes a lot of sense, because of course you get a much better yield than for the German bond, worse than the Italian, but you're taking much less risk, because think about it, when the European Union is issuing their own bonds, they are securing it their way, and you know that such a big region will never default. You know, I mean, can you imagine? It's like the US will never default. That's why they are rated so well, and that's why the interest rate is pretty low. But it's still better than the super low German interest rate, and you get more exposure to different economies and these kind of things. So if you're already investing in bonds and in the European Union, for example, then it makes a lot of sense. Myself, I do not invest in bonds usually, because especially right now, I mean, look at the yield. 0.1% over 10 years, meaning you get 0.1% each year safely, but that's the same as you get on your bank account if you just park the money there and just leave it there on your simple bank account. So that's why right now it doesn't make sense. Of course, if the interest rates go up and down and stuff, it's going to be a different discussion. But right now, of course, it doesn't make sense to invest in something that gives you 0.1% over 10 years, you know what I mean? But I think it really depends where you are, if you're a bond investor or not. Because if you're a bond investor, it's interesting. If you're not a bond investor, if you prefer stocks, for example, if you prefer real estate, of course, don't forget to diversify, not buying single shares, but buying the S&P 500, for example, index. Then of course bonds are, I mean, 0.1%, not very interesting, okay? So now that you know all that stuff, I hope this was helpful. Don't forget to like and subscribe. Helps to spread the word if you like. And if you want to see more of that stuff, don't forget to subscribe, because I post corporate finance, market finance videos every Sunday. Enjoy. See you next week. Bye bye, guys.